So, like I said, today will be the last lecture day for short-term decisions. So far, this is going to be the third lecture day under the topic. So we have done deleting of a segment. We have also had lectures under make or buy. Now let's have acceptance or rejection of a special order. Okay, so you may want to jot down a short note. But before you put down any notes, there's something you need to understand under short-term, under acceptance or rejection of a special order. And what you need to know is the fact that when a company is operating below the installed capacity level, such company may have spare capacity to accept or to conduct extra activity arising from the special order. Generally, when it comes to a special order, the price is usually available at a price below the company's quoted price. What that means is that if, for example, a company has capacity to produce and the company is currently operating at 80% capacity, it means that the company has 20% spare time. So out of the spare time of 20%, if there's any special order for the company to execute, it is from that spare capacity that they are going to conduct the activity. And then usually the price at which the customer will offer the company for the special order will be lower than what the company will normally earn in the market, what the company will normally sell its products in the market. So, and then another thing is that this special order is a one-off kind of contract that may or may not resurface again. So that's just the background of acceptance of a special order. So let's put down a short note. Okay. Let me go back to where you have so that you can be speaking on the same page. Acceptance, rejection of a special order. Okay, almost there. All right then. So let's put down a short note, please. Excuse me, let me pick my pen. Okay. So when a company is operating below the installed capacity level, when a company is operating below the installed capacity level, the company may accept or reject a special order depending on whether the special order is profitable or not. My screen sharing is paused. Why? Let me confirm what's happening. Okay. Let me see. I don't know. It's telling me my screen sharing is pause. Please, can you hear me?
Yes,
Hello,
sir, we
can
can
you?
hear.
Yes.
Yes, please.
So showing that my screen sharing is paused. So let me reshare again. So we start all over again. So let me know if you can see my screen.
Yes, sir. We can see your screen.
All right,
I
thank
can
you.
see your screen, yeah.
All right, thank you. So like I was trying to say, a special order is a one-time kind of order, often involving a large quantity and usually available at a price below the company's market price. So when an organization is operating below the installed capacity level, the company may accept or reject a special order at a lower price. Let me take it again. A special order is usually a one-time customer order, often involving a large quantity and usually available at a price below the company's product market price. Okay? When an organization is operating below the installed capacity level, the company may accept or reject a special order at a lower price, depending on whether it is profitable or not. I believe that is taken. It is believed that the special order we produce, it is believed that the special order will be produced by using the spare capacity available within the organization. It is believed that the special order will be produced by utilizing the available spare capacity available within the organization. Okay? Now, the decision of this nature can be considered or examined critically from the following perspectives, including economic perspective, including economic perspectives. Now, when you want to analyze the economic angle of the decision to accept or not to accept a special order, the most important thing to do is to compare the sales value from the special order with the relevant costs of making the special order, whether it will result in additional profits or loss to the organization. I repeat, when analyzing the economic perspective of a special order, the most important thing to do is to compare the revenue or sales value from the special order with the associated relevant costs of making the special order, whether it will result in additional profits or loss to the organization. At times, it is also possible to determine the minimum price or relevant cost to be quoted for the special order. Under this situation, there will be no need to determine profit or loss arising from the special order. What I'm trying to say in essence is that once you are asked to determine the minimum price or relevant cost to be quoted for the special order, it means that you are supposed to determine only the cost. There will be nothing like you determining profit or loss. And in the question, you are not going to see anything like sales value. Everything will just purely be cost. So how do you then determine profit or loss? Using incremental analysis. So when you are analyzing the economic perspective, you are going to consider, like I said, the sales value. The format you have here on the screen is what you are going to use. You go into the question, you identify the sales value arising from the special order. Now, one thing you need to know is that when you are carrying out the economic analysis of the special order, your focus should be on the special. You are less concerned with the company's normal operation. So your focus should be on the special order. What is the sales value arising from the special order? What is the relevant cost of making the special order? So any cost that the company will normally incur during its normal activities should not be included. So the focus should be 100% on the special order. Therefore, you are going to compare the sales value. So how much is the sales value? The post. Once you have the sales value available, then of course, you consider the relevant cost of making the special order, like direct material, direct labor, okay, direct expenses, variable production overheads, all right? Then you consider if there's any incremental, specific, direct, attributable fixed cost in the question. Not only that, if there's any opportunity cost, you need to consider it, or contribution loss as a result of the special order. If the company will incur any transportation cost associated with the special order, you have to include that. Any other expenses that the company will incur for the purpose of executing the special order should be considered. So at the end of the day, you need to compare the difference between the sales value and the relevant cost of making the special order, whether it will result into profits or loss to the organization. So that's what you need to do under economic perspective of the special order. Then, what's the decision rule? You will accept the special order if the order will result in additional profit to the organization. Then you reject it if there will be loss to be incurred on the special order. So you only accept the special order if it will result to additional profit to the organization. But like I mentioned the other time, in case you are asked to determine profit or loss, you are asked to determine minimum price to quote for the special order. In this case, there will be nothing like determining profit or loss, because the examiner wants you to determine minimum price to quote. That is your relevant cost of making the special order. So watch out for that. So that's what you need to do under this circumstance. Then the second area, the second perspective you need to consider under special order is the qualitative factors. What are the relevant qualitative factors you need to consider? Okay, what are those relevant qualitative factors you need to consider for the special order? The first thing you need to consider, there are some critical questions, germane questions, the management, you must ask the management, or the management must be able to provide answer to. One is that, is it certain that fixed cost will remain constant within the relevant range? What that means is that because any fixed cost will not impact this special order. So it is assumed that whether you accept this special order or not, the company will surely incur the fixed cost. But if the fixed cost will increase as a result of this special order, then you need to include that fixed cost as part of the cost of the special order. And that's why we need to ask this question, that is it certain that fixed cost will remain constant? That is, it will not change within the relevant range. Number two, we also need to know if there are other ways of utilizing the spare capacity instead of the special order. When a company is not fully operating at full capacity, there will be spare capacity or idle time or idle capacity. So if you now have a special order that you want to execute utilizing the spare capacity, then you need to ask yourself, is there any alternative way of using the spare capacity instead of the special order that will be more profitable to the organization? So you must ask that question. Not only that, number three, you also need to ask, will lowering the selling price influences or attract other customers? You know, we said earlier on when I was explaining that the special order will usually be available below the company's quoted market price. Therefore, because the company has lowered its prices, its selling price, so we want to know that will lowering the selling price influences or attract other customers to want to do the same. It is possible the company may still have spare capacity even after the special order. So if other customers are willing and ready to do to quote for the same thing, then that will be additional profit for the organization. Then number four, we also need to find out if the special order is the most profitable way of using the spare capacity, or will the long-term plans for using the capacity be affected? Okay, that's another question you need to pose to the management. Not only that, another aspect you can look at is workers' morale. Okay, you also need to look at workers' morale. Will this special order lower or affect workers' morale, which of course may result to low productivity? How would the special order lower morale of workers? You know, when you have spare capacity, it means that the employee, they will have a freedom, they will have a free time because they are not fully occupied. They will have a free time. Now that you want to utilize the spare capacity, it's like you are encroaching on their freedom, on their resting time, you know. So as a result, the workers may grumble, even though they are going to do the work, but they may grumble because they are not satisfied with that decision. Therefore, you need to know as a company if this special order will affect workers' morale. So these are some of the qualitative factors you need to consider under acceptance or rejection of a special order. So in summary, what we have discussed so far under acceptance or rejection of a special order is that, one, a special order is a one-off contract that is usually available at a price below the company's quoted market price. And it is believed that the company will utilize the spare capacity to execute the special order because the company is operating below the installed capacity. The company is underutilizing its capacity. So as a result, the company may accept or reject a special order. So if the special order results in profits, additional profit to the organization, the order will be accepted. But if not, the order will be rejected. And I also said that it is possible examiner may want you to determine minimum price to quote or relevant cost to accept for the special order. So all of these things you need to understand it. And then the most frequent areas that I can usually test under short-term decisions is the acceptance or rejection of a special order. It's very common. And it can cut across any other topic. You can have optimal product mix, for example, involving special order. Okay, so it can be incorporated in any of the other topics in performance management. So yeah, so that's that. Let's have illustration to that effect. We are not going to solve more than 2 illustrations, and then thereafter we can then I can then introduce you to optimal product mix. Okay, then. So let's start with illustration number 3. Scudetto Limited. Yes, let me see. Who will read for us? Any volunteer to read? Who will try? Who will read for us? Tolulope?
Okay.
Okay, yeah, read. Somebody has volunteered. Read.
Okay. Scudetto Limited, a pharmaceutical company operating from Enugu, Nigeria. Recently, the company received an order from Eyimba Football Club to produce a technological device for the treatment of growing injury. The contract is expected to be completed in 1 year time at a contract price of 3 million naira. Currently, the company has spent 400,000 on research and development, and the additional cost of 250,000 naira on market survey to promote the device to other football clubs in Nigeria. The following information relates to the contract. Materials. The contract will require material Zinco. This material was bought 2 years ago at a cost of 600,000 naira. The material is toxic, and if not used for the contract, it must be disposed at a cost of 50,000 naira. Labor. Skilled labor is hard to recruit in the labor market. In the recent management meeting, the sales manager suggested that 2 workers from production department on a current wage of 400,000 can be transferred to execute the order. The production manager does not buy the idea because he believes that transferring 2 of his existing staff to execute the contract will lower productivity. The management resolved that the staff should be transferred since the company is finding it difficult to recruit additional staff. However, if this happens, the management believes that sales will drop by 1,500,000 at a marginal cost of 1 million naira. Production overhead. The fixed production overhead absorbed relates to labor and would amount to 200,000. Research and development. It has been concluded that when the work on the contract is completed, the research and development department will be shut down. And research and development staff costs for the year includes wages of 600,000 and redundancy and severance pay of 150,000 now, or 350 in 1 year time. Equipment. The contract utilizes a special equipment which cost 180,000 naira 3 years ago. It has a residual value of 30,000 in another 2 years, and a current disposal value of 80,000. If the equipment is used in the contract, it is estimated that the disposal value in 1 year's time will be 60,000. Share of general building services. The contract is charged with 350,000 naira per annum to cover general building expenses, and building space is currently being used for the contract. However, a neighboring business has approached Scudetto Limited to lease this space for 1 year at a consideration of 70,000 required. Advise the CEO of Scudetto Limited if the contract should be accepted. State the assumption made in your calculation.
Thank you. I appreciate. So that's the question. Examiner is asking you to advise the CEO of Scudetto Limited if the contract should be accepted. State any assumption made in your calculation. Ignore the time value of money. This means that you are not expected to discount the future expected cash flow associated with these contracts. However, so examiner is asking you, that's a requirement, to advise the CEO of Scudetto Limited if the contract should be accepted. So this is purely relevant costing. This is purely relevant costing. Examiner wants you to determine relevant costing, all right? So if that is the case, if then in the question you have sales value, you also have relevant cost, then in that case, you are going to determine additional profit or loss associated with this special order. And like I mentioned to you, when we had relevant costing, I said that mostly relevant costing are solved through the additional information. So if that is the case, so let's solve this question quickly. I will stop sharing this document, then I will present you with the working note so that within the next 20 minutes, we should be done maximum. Okay. Let me know if you can see my screen, please. Can you?
Yes, sir.
Yes, we can.
All right, then. Thank you. So let's move to. So the name of this company is Scudetto Limited. I would then say Scudetto. So examiner is asking us to advise whether the contract should be accepted. Therefore, I would then say acceptance or rejection. Acceptance or rejection of, is there any name for the contracts? Let's check. Scudetto Limited is a pharmaceutical company operating for recently. The company received another Eniba football call to do what? Okay, to produce a technological device for the treatment of growing injury. All right then. So what should then be our response? I mean, our title. What should be our title? So we are going to say, okay. Excuse me, let me pick my pen. You're not working. Sorry. Okay. I can say acceptance or rejection of a special order. Of a special order to produce a technological device. Okay? You can simply say acceptance or rejection of a special order as your heading. So it's not compulsory that you must write it this way. Just have a title, or you can say incremental analysis of the special order. You can also say acceptance or rejection of a special order. So whatever you want to use as the heading, you are good to go. Now, let's go back to the question. Let's go through the question together. So let's read from the first paragraph. Scudetto Limited is a pharmaceutical company operating from Enugu, Nigeria. Recently, the company received an order from Enyimba Football Club to produce a technological device for the treatment of groin injury. The contract is expected to be completed in 1 year's time at a contract price of 3 million naira. So examiner has given me a cash inflow of 3 million naira. So let's go and include that. I will say contract price. This contract price is just like revenue. So 3 million naira. Let's move on to the next one. Currently, the company has spent 400,000 naira on research and development and an additional cost of 250,000 naira on market survey to promote the device to other football clubs in Nigeria. 400,000 has been spent on research and development. Tell me, is that 400,000 relevant or irrelevant?
Irrelevant, sir.
Why is it not relevant?
Because it is a sunk cost.
It's a sunk cost. Any past cost is a sunk cost, and a sunk cost is irrelevant cost and should be ignored. You are correct. Then we also told that and an additional cost of 250,000 naira on market survey to promote the device. Of course, the same thing applies to that item. So both the 400,000 naira and the 250,000 naira are irrelevant and should be ignored, because these are the areas you are going to be commenting when you want to state your assumption. Because this calculation, whether you are asked or not, you must state your assumptions. So the 400,000 and 250,000 naira are past costs, are sunk costs, and therefore not relevant. So let's move to the additional information. The material, the contract will require material Zinco. This material was bought 2 years ago at a cost of 600,000 naira. I ask again, this 600,000 naira, is it relevant or irrelevant?
Irrelevant.
Why is it not relevant?
Because it was bought 2 years ago.
Was bought 2 years ago is an historical cost. Is an historical cost or sunk cost, and therefore irrelevant. You ignore. All right. The material is toxic, and if not used for the contract, it must be disposed of at a cost of 50,000 naira. That 50,000 naira, how do we treat it? Is it relevant or irrelevant?
50,000 naira is relevant.
It's relevant.
Why is it relevant?
Because we have to pay the 50,000 if the material is not used.
Okay. So that 50,000 naira, is it a cash inflow or cash outflow?
It's a cash flow.
So please, if you want to talk, number one, you mention your name and you give me the answer, and you have to justify your position. Okay? So who will answer that question? 50,000 naira, relevant or irrelevant? So if it is relevant, then why is it relevant? Who is speaking?
Anthony.
Elizabeth Alliance, sir.
Tony, go ahead, you are the first.
Okay, sir. The 50,000 is relevant in the sense that although it's going to be a savings to the company because it's an inflow, because the item was toxic and disposed of. So in disposing it, there's an income that is gained in disposing it, which is not relevant, which is going to be a revenue, that's a profit and not an expense. So,
All right. All right. Thank you very much, Tony. You are correct. Now, for those who miss the class under relevant costing, you must understand the treatment of disposal value. Like I explained to you when we had relevant costing, this disposal value is also known as net realizable value, the amount at which the item of material can be disposed currently in the market. The item you have in the inventory, the item of material you have in the inventory, you've already purchased it previously. You've bought it in the past. Maybe due to over purchasing or because of the fact that that material will not be needed again. Therefore, you will need to dispose it. When you dispose an item, when you sell an item, you are going to get money in return. That is cash inflow. Therefore, disposal value is a saving, will represent a saving to the organization. But the challenge that students normally face is the fact that examiner will not tell you it's a saving. Usually, examiner will tell you that the material will be disposed of at a cost. Because examiner has mentioned cost, student will not think, okay, it's a cost. The company will spend money again to dispose of. No. Even in this question, you can see examiner is telling you that the material is toxic. Forget about whatever terminology the examiner has told you. When you dispose an item of inventory, then it will attract a saving to the organization because that material has originally been bought. Now that you want to dispose it, it's just like you sell something at a scrap. That's why we say scrap value. It's either you call it scrap value, disposal value, net realizable value, trading value, resale value. It can be called anything. Once you sell something, you are going to get money in return. Therefore, this 50,000 naira is a saving to the organization. It's a cash inflow. Therefore, let us go and account for that. So I will then come here, disposal value. Saving or material disposal. Material disposal. Saving 50,000 naira. Okay. Move on. Let's go to the next item. Labor. I hope you have the material with you. Labor. Skilled labor is how to recruit in the labor market. In the recent management meeting, the sales manager suggested that 2 workers from production department on a current wage of 400,000 naira can be transferred to execute the order. The production manager does not buy the idea because he believes that transferring 2 of the existing staff to execute the contracts will lower productivity. The management resolved that the staff should be transferred since the company is finding it difficult to recruit additional staff. However, if this happens, the management believes that sales will drop by 150,000 naira at a marginal cost of, 1.5 million naira at a marginal cost of 1 million naira. So how do we treat? In this scenario, we have 2 items that needs to be discussed. The first one is labor cost of 400,000 naira. So how do we treat that 400,000 naira? I'm asking you, please. How do we treat the 400,000 naira? Is it relevant or irrelevant?
hello, sir.
Who's
Yes, sir.
speaking?
It's me, Anthony.
Okay, Tony.
I think
Go ahead.
the 400,000 is irrelevant in the sense that it is not useful for this transaction because whether the 400,000 is a salary, which is a fixed cost. which is a mandatory cost, whether they do the job or they didn't do the job. It's a constant because salary is a constant something. So irrespective of that, the salary will be paid. So it's not relevant to this particular contract. So that's why I see.
Okay. Thank you for that position. Then who again? Or you want me to be calling names? Who wants to try? How do we treat that 400,000 naira? Abiodun? Abiodun, I'm calling on you. How do we treat the 400,000 naira? Pascal, how do we treat the 400,000 naira?
So the 400,000 naira is irrelevant.
Why?
Based on is a fixed cost.
It's a fixed cost, okay? All right, then. Let me have one more person. Yes, who wants to try again?
Hosanna,
James, okay. Who is talking?
Hosanna, sir.
Osana, okay, try.
The 400,000 naira is irrelevant.
Why?
Because the existing staff of the company are the ones to execute the job, sir.
Okay. All right, then. Thank you. Yes, thank you everyone that participated in this labor cost. Now, once again, let's read the scenario together. We are told that skilled labor is hard to recruit in the labor market. Remember, when we had relevant costing, I demonstrated for you how to identify relevant costs for labor. I also draw a diagram for you that where you have full capacity, at full capacity, if the company can recruit more labor, then the other leg is if the company cannot recruit more labor. If the company can recruit more labor, relevant cost would be the extra labor costs incurred from recruiting the labor. Now, if the company cannot recruit more labor, relevant cost would be the cost of diverting resources. Do you get that? Cost of diverting resources to execute the order. In this case, examiner has told you that skilled labor is hard to find in the labor market. In the recent management meeting, it was suggested that by sales manager that 2 workers from production department on a current wage of 400,000 can be transferred to execute the order. Remember, you have to pay salary to these workers, to these 2 workers. If they are not where they are currently working, they are not going to work in that position because they want to come and execute this order. The company is diverting resources. As a result of diverting that resources, there will be loss of production. There will be loss of it will lower the productivity as suggested by the production manager. Now, the issue now is that this 400,000 naira is irrelevant or irrelevant because for the period of this contract, these 2 staff will be working to execute this special order. Won't you pay them? Because in their current position, they are not working because you want to transfer them to come and be working on this special order. If not because of this special order, they will be working in their current position. So this 400,000 naira is relevant. You have to account for it because they are not working in their current position. They have transferred them to come and execute this order. So it is this project, it is this new contract that will bear their salary for the period of the contracts. Just like you, maybe some of you that are working for accounting firm, maybe you are now seconded to a particular client to go and work in the client office for an extended period. It is that client that will bear your salary for that period, because your cost would have been embedded in the cost of charge, in the cost the company will charge the client. It's the same thing here. Because of this special order, so they have to leave their current position to come and execute the order. As a result, the company will be losing productivity. So that 400,000 naira is a salary that the company must pay to the skilled workers, even though it's a fixed cost. But if not because of this contract, the company wouldn't. I mean, it could have been under the current position where they are currently working. So we have to account for this 400,000. It's relevant. Therefore, I would then come here. Relevant costs of making relevant cost of making the special order. So the first item is labor. Under labor, 400,000 naira. Move on. Next item. Still on that scenario. However, the last paragraph the last statement there said that, however, if this happens, the management believes that sales will drop by 1.5 million naira at a marginal cost of 1 million naira. So there is a contribution loss. There is a contribution loss of 500,000 naira. Okay, that's a contribution loss of 500,000 naira. So let's account for that contribution loss. How? 1.5 million minus 1 million. That's 500,000. Let me adjust this. Okay. Next item, please. Production overheads. The fixed production overhead absorbed related to labor and will amount to 200,000 naira. Fixed production overhead. This is irrelevant. The 200,000 naira is irrelevant. This is because whether the company executes this contract or not, the fixed production overhead will be incurred, therefore ignore. Next item, research and development staff. It has been concluded that when the work on this contract is completed, the research and development department will be shut down. The R&D staff for the year includes, the R&D staff costs for the year includes wages of 600,000 naira and redundancy and severance pay of 150,000 naira now or 350,000 naira in 1 year's time. So how do we treat this? The research and development staff costs for the year include wages of 600,000 naira. That 600,000 naira, is it relevant or irrelevant? Yes. The 600,000 naira, is it relevant or irrelevant? Hello? I'm asking. The 600,000 naira, is it relevant or irrelevant? Who wants to try? Okay, let's move on. So the R&D staff cost of
I think it's Pascal. I think it's relevant. I feel
relevant
it's relevant
or irrelevant?
It's relevant.
Why?
Because it can be seen that it's stated that when the contract is completed, the department will be shut down. So the department will be shut down after the completion of the contract.
Okay. All right. So you are correct. The 600,000 naira is relevant, and of course, it's a staff cost, and it is specifically for the contract. So it's a relevant cost that we have to consider. So R&D, staff cost, 600,000. Move on to the next one. Redundancy and severance pay of 150,000 naira now or 350,000 naira in 1 year's time. How do we treat that information? Redundancy and severance pay. We have 150,000. We also have 350,000. And how do we treat it? Yes.
Had it been where Pascal again, had it been where given a discount factor, we would have considered that in discounting the present value of the future cost of 350,000. But since we are not giving that, we'll just work with the actual figures and consider the 150,000 that is lower.
Okay, all right. Thank you. So any other person who wants to try again? How do we treat that information? Redundancy and severance pay. How do we treat it? Tony is saying it's relevant. Okay, which one? How do we treat it? We have 150. We also have 350. How do we treat that information? Quickly, time is running out. I want you guys to suggest. Pascal has given his own position. Any other person? Okay, then, to save time. Yes. The redundancy and severance, if the department is shut down, the redundancy and severance pay of 150, that redundancy and severance pay of 150,000 will be paid now. If it shut down the department now means immediately. So the company will pay 150. But if in 1 year's time, the company will pay redundancy of 350. This means that the redundancy has grown from 150,000 naira to 350,000 naira. This is an incremental cost. Your severance benefits or your severance pay has increased from 150 to 350,000 naira. Therefore, you need to consider the incremental cost between now and 1 year later. All right. Therefore, only 200,000 naira will be considered for the severance pay. Let's go and account for that. Incremental. Let me just put severance, redundancy and severance pay. $350,000 minus 150,000. So that's 200,000. So that's an incremental cost. Our severance benefit has increased from 150,000 naira now to 350,000 naira in 1 year's time. That's an incremental cost. You have to account for that. Next item, please. Equipment. The contract utilizes a special equipment which cost 180,000 naira 3 years ago. It has a residual value of 30,000 naira in another 2 years and a current disposal value of 80,000 naira. If the equipment is used in the contract, it is estimated that the disposal value in a year's time will be 60,000 naira. Now, first thing first, the 180,000 naira 3 years ago is a past cost and therefore irrelevant. We're now told that it has a residual, that particular equipment has a residual value of 30,000 naira in another 2 years. In 2 years' time, the residual value of this equipment will be 30,000. But the current disposal value, if you want to sell the equipment now, the equipment worth 80,000 naira. So if the equipment is used for the contract, it is estimated that the disposal value in a year's time, after 1 year, when this contract is completed, the disposal value will reduce to 60,000 naira from 80,000 naira now to 60,000 naira in 1 year's time. That means what is the portion? What is the reduction in value that as a result of this contract, this equipment has lost value of 20,000 naira? That is 80,000 naira minus 60,000 naira. So let's go and account for that quickly. So I would then say equipment. Let me see. Yes, equipment, special equipment. Special equipment. In 1 year's time, after the contract is completed, the disposal value of this equipment will be 80,000 naira. But if this equipment is to be disposed now, the company will earn 60,000 naira. Because the machine will be used for the contract, the value of the machine has reduced by 20,000 naira. Therefore, that 20,000 naira should be part of the cost of the contract. Because if not because of this contract, this machine or this equipment would have been disposed at 80,000 naira. Let's move to the next item. Share of general building services. The contract is charged with 350,000 naira per annum to cover general building expenses. The building space is currently being used for the contracts. However, a neighboring business has approached Kudeto Limited to lease the space for 1 year at a consideration of 70,000 naira. Now, how do we treat this? We are told that the contract is charged with 350,000 naira per annum to cover general building expenses. General building expenses is just an apportionment. It's a general fiscal. So that 350,000 naira is irrelevant. We ignore it. Because whether you execute this special order or not, the company will pay that 350. Therefore, it's not relevant. However, we are told that the building space is currently being used for the contracts. The building space is currently being used for the contracts. However, a neighboring business, you want to say something? Okay. So the building space is currently being used. And we're now told that a neighboring business has approached Scudeto Limited to lease the space for 1 year at a consideration of 70,000 naira. You will notice that the company cannot earn that revenue of 70,000 naira because the company is using the space. There is no how the company can rent out to a neighboring business at 70,000 naira because the company is using the space for the contracts. Therefore, that's an opportunity cost. The benefit forgone as a result of using the space for the contract. Hence, the 70,000 naira is a relevant cost you must consider. So I can say contribution loss or opportunity cost. $70,000. What else? That's end of it. So let's add up all the numbers. Let's add up all the numbers. I did not leave a space here, so I'm supposed to leave a space. Okay. Or since I've forgotten that, let me just leave it like that. So let us add up Bring out your calculator, please. Let's confirm this, all the relevant costs. So I have 900,000, 1.5, 1.790. That's 1.790. No need for calculator. 1,790,000 minus 3,050,000. 3,050,000 minus 1,790 equal 1,260. Here is 1,260,000. So this represents additional profit or incremental profits arising from the contracts. So examiner is now asking you to advise the CEO of Kudeto Limited if the contracts should be accepted. So we are going to say that the contracts to produce the technological device should be accepted. Okay? The contracts to produce let me write that. To produce the technological device should be accepted. Considering the additional profits of 1,260,000 naira. So this is not sufficient. You have just done one bit of the question. Whether examiner asks you or not, you have to state your assumptions. How did you arrive at your numbers? Okay, so you have to state your assumptions. All right, so let's state our assumption. You're writing assumptions. The underlying assumption to the above calculations are stated below. The underlying assumption to the above calculations are stated below. Assumptions, okay? So I said the underlying assumptions to the above calculation are stated below. So what are the assumptions that we have made in this question? In the question, the first item we talk about was research and development cost. Not only that, including the market survey. Therefore, I will say R&D, number one, R&D and market survey costs. Okay. So I would then say the cost The R&D and market survey costs, the R&D and then market survey costs of how much is R&D in the question? The R&D of, is that where we started from? No, the first item should be material. No, yes, R&D. We are told that currently the company has spent 400,000 naira on research and development and additional cost of 250,000 naira on market survey to promote the device. So we ignore those two costs because they are sunk costs. Therefore, I would then say the R&D and market survey costs of 400,000 and 250,000, I think. How much is that? Yes, 250,000 naira respectively, and 250,000 naira respectively are sunk costs, and therefore irrelevant. Number two, what other things did we ignore in the question? We also talk about material, okay? Talk about material. There is 600,000 naira on the material. The contract will require material Zinco. This material was bought 2 years ago at a cost of 600,000 naira. So we ignore that 600,000. So why? I would then say material. The cost of material Zinco of 600,000 naira incurred 2 years ago is a sunk cost. And therefore not relevant to the contract. The only relevant costs, the only relevant cash flow. Let me go back to the material is toxic, and if not used for the contract, it must be disposed of at a cost of 50,000 naira. Therefore, I will say the only relevant cash flow associated with the contracts is the disposal value of 50,000 naira, which represents a saving to Scudetto Limited. Next item, we also need to talk about labor costs. Then we are going to, examiner is asking us, we are told that the skilled labor is out to recruit in the labor market. In the recent management meeting, the sales manager suggested that 2 workers from the production department on a current wage of 400,000 naira can be transferred to execute the order. Therefore, we can say that the current wage bill of 400,000 naira for the two production department staff is relevant because the workers will work on the contract and must be paid. Okay. Number 3, labor. The current wage. The current wage bill of 400,000 naira for the two production department. 400,000 naira for the two production department is relevant because the workers will work to execute the contracts and must be paid because they are currently working at full capacity on another project, but because the company cannot recruit more staff, so it is these two staff that will be transferred to come and execute the order. Therefore, the company must pay for their salaries for the period they are going to work on the contracts. So that's that. There's another information in that particular scenario. We're also told that there's a contribution loss. There's a contribution loss of 500,000 naira, representing the difference between the lost revenue and the marginal cost. Okay. Yeah. If this happens, the management believe that sales will drop by, yeah. I will say, in addition, a contribution loss of 500,000 naira. That is 1.5 million minus 1 million naira will be incurred or will be charged to the contracts. Charged to the contracts as a result of diverting resources. As a result of diverting resources. That's wow. Time and is past spent. Next item. Let's talk about production overhead. The production overhead of 200,000 naira will surely be incurred irrespective of decision taken on the contracts. Okay? Production overhead, number 4. Production overheads. The production overheads, the production fixed overhead will be incurred irrespective The provision of fixed overhead of 200,000 naira. Of 200,000 naira will be incurred irrespective of the decision taken on the contracts. Therefore, the fixed overhead is not relevant. We ignore it. Next item. Research and development staff costs. Okay, research and development staff costs. So we may say the staff wages of 600,000 naira is relevant because the cost will be saved if the contract did not go ahead. And also, the redundancy and severance pay of 350,000 naira and 150,000 naira are not relevant. Only the incremental cost is relevant. Let's take that. Number 5. Research. R&D staff costs. Let me see again. Yeah. R&D staff costs. So the R&D staff costs of 600,000 naira is relevant. The R&D staff cost of 600,000 naira is relevant. Because it will be saved if the contracts did not go ahead. Because it will be saved if the contracts didn't go ahead. Okay, let me write this. So what else? In addition to that, there is also an incremental cost on redundancy. So redundancy and severance pay the redundancy and severance pay of 150,000 naira and 350,000 naira are not relevant. The only relevant cost is the incremental. Is the incremental cost of 200,000 naira, representing the difference between the two costs. That is 350,000 minus 150,000 naira. So that's that. Number next, we need to talk about equipment. So we need to talk about the equipment. The equipment contract utilized a special equipment. Sorry, the contract utilized a special equipment which cost 180,000 naira 3 years ago. So let's treat that. So I will say the original cost of the equipment of 180,000 naira 3 years ago is a sunk cost. Okay. Number 6. Equipment. The equipment cost of 180,000 naira is a sunk cost and not relevant to this calculation. The only relevant cost is what's the relevant cost there? Let's go back to the question. The only relevant cost associated with the equipment is the loss in value of 20,000 naira. Is the loss in value of 20,000 naira. That is 80,000 naira minus 60,000 naira. That's it. The last one, share of general building services. The building overhead charges of 350,000 naira is irrelevant because it's an apportionment. Okay. Number 7. Number 7, share of general building services. Share of general building services. The share of general building services. Okay. The building overhead charges. The building overhead charges of how much is it? 350,000 naira per annum. Of 350,000 naira per annum is irrelevant because it's an apportionment. Any apportionment is irrelevant cost. Okay. So it's not relevant. However, there is an opportunity cost of 70,000 naira. However, there is an opportunity cost of 70,000 naira. An opportunity cost of 70,000 naira will be incurred. Okay, will be incurred for the lease renter or an opportunity cost of 70,000 naira for the lease renter is attributable to the contract. That's it. That's it. So that's it. That's end of the question. We're asked to advise the CEO of Scudetto Limited if the contract should be accepted, then state any assumption made in your calculation. Like I've been emphasizing, whether you are asked or not, you have to state your assumption. It is implied in the question. Whenever you solve it, whenever you are given a scenario, you pick some questions. I mean, you pick some figures and you ignore the others. So you have to state the reason why or how you have come about your numbers. You have to. It is important, whether examiner asks you or not. It is implied. You have to state your assumption. So that's end of the question. Before we move to the next one, let me hear from you. Do you have any question for me on this question we just solved? So far, any question? So in the absence of no question, let's go to...
Excuse me, sir.
Yes, go ahead.
I have a question in that research and development staff.
Okay.
They said R&D staff cost for the year includes wages of 600,000 and redundancy and severance pay of 150,000 now.
Yeah.
Or 350,000 in 1 year time.
Yeah.
So why did we now do the difference, the incremental cost?
Yes, the reason why we have to account for incremental costs, if the company wants to pay the redundancy fee now, the company will pay 150,000 naira. That means before the commencement of the project, the redundancy fee is 50,000 naira that the company will pay. After executing the project, the redundancy fee has increased to 350. Therefore, how much is attributable to the contracts on redundancy fee? You cannot charge the project 150, because the project has not even commenced. The project has not commenced, so that 150,000 naira you can't charge the project. Again, why do you want to charge the project 350? The entire 350, when you know that before the commencement of the project, your redundancy fee is 150 already. So it is only the incremental cost, because that's why we said that relevant costs are incremental costs. Incremental costs are costs that change between alternatives. There are two alternatives cost of action here. Either the company pay 150,000 naira redundancy fee now or 350,000 naira 1 year later. What has changed? 200,000 naira is what has changed, which represents the incremental cost. Do you get it now?
Okay.
Yeah.
It's clear. Thank you.
You're welcome. Any other question on Scudetto illustration we just solved? All right then. In the absence of none.
Sorry, sir.
Who is speaking?
Still Emeka.
Okay. Go ahead.
Okay. For the material.
Okay.
Yeah. We have material Zinco already in stock 2 years ago at the cost of 600,000. So normally they said if not used for the contract, it must be disposed of at a cost of 50,000. But they said the contracts to require material Zinco. Hello? Hello?
Hello, take your question again. My
Oh,
network was misbehaving.
okay. No, the question for the material said it has a sunk cost of 600,000. Then they said if not used for the contract, it must be
Yeah,
disposed of at the cost of 50,000. But the
yeah,
question says the contract will require material zinco, meaning it was
yeah,
used.
yeah,
So
yeah.
was there need for the disposal cost again since it was used?
See, yes, that is how to identify relevant costs of material. Generally, any material you have in the warehouse, any material you have in the inventory is irrelevant because you've already purchased the material, therefore meaning that you are not going to incur any cost on that material again. Even though in this question, the examiner is telling you that the contract will require material zinco. This material was bought 2 years ago. Ordinarily, by that information bought 2 years ago, it means that the material is in inventory. So that
It's a sunk
600,000
cost.
naira is irrelevant.
It's
It's a past
irrelevant.
cost. It's a sunk cost. Okay. Now, you're
Yes.
now told that the material you have in the inventory, that material zinco that you have in the inventory is toxic. And if not used for the contracts, it will be disposed of at a cost of 50,000 naira. That's a saving. You are selling the material you have in the inventory at 50,000 naira. So it's a saving. That saving is a relevant cash flow that you have to account for. All right?
Okay. So sorry, sir.
Yeah,
So
go ahead.
let's just say wherever we see disposal costs, we should make use of it.
That's what I just said. You know, I
Oh,
explained this when we had relevant costing in details. I explained it in detail. So whenever you are given, whenever there is a disposal value is the amount at which the item, the material held in stock can be disposed. You already have that material in the stock. So once you dispose it, generally, if you are told that the material is no longer needed and will be disposed, so the disposal value is a saving to the organization. All right. So whenever you are told that material will be disposed at a cost, it is not a cost, it's a saving. You are going to treat it as a saving. All right. So let's move to another illustration. Okay. Let's have one more illustration under this. Let's solve the question that involves. Please, you have an assignment for me. You are going to go and attempt illustration number 1, Conco Below Limited. It's an assignment that you have to attempt. Not later than Friday, you have to submit it. I've been giving an assignment for some time now, and you guys have refused to attempt the assignment, and which is not good for you. I've been saying this all this while. Again, I'm giving you this assignment. Go and attempt illustration number 1, Conco Below Limited. And you have to submit not later than Friday. All right? So let's have another illustration. Illustration number 2. Who will read for us? Somebody should read illustration number 2. Abiodun?
Boston's Limited.
Okay, go ahead, please. Go ahead. Samuel.
Boston's Limited has capacity to produce 16,000 units per month.
Can you
But
get
current
closer
plan,
to your mic, or
can you hear me now?
it's better?
Boston's
Go ahead.
Limited has capacity to produce 16,000 units per month. But current plans shows monthly production and sales of 10,000 units at 15 naira each. Cost per unit are as follows. Direct materials, 5 naira. Direct
Leave those
labor,
one. Required.
okay, required. One, should the company accept a special order for 4,000 units at 10 naira per unit? Two, what is the maximum price the company should be willing to pay to an outside supplier who is interested in manufacturing this product? Three, what would be the effect on the monthly contribution margin if the sales price was reduced to 14 naira, resulting in a 10% increase in sales volume?
Thank you very much, Samuel. So let's quickly solve this illustration. Examiner is asking you whether the company should accept a special order for 4,000 units at 10 naira per unit. You will notice from this question that from the first paragraph, this company has capacity to produce 16,000 units. That's at full capacity, the company can produce 16,000 units. But we are told that currently the company is producing 10,000 units. So that means this company is operating below the installed capacity level. Not only that, the market price for the company's products is 15 naira per unit. But you are given in the requirement number one, you are told that there's a special order to produce 4,000 units at 10 naira per unit. So out of the spare capacity of 6,000 units is where you are going to produce the 4,000. But the 4,000 is only available for 10 naira, which is below the company's market price of 15 naira. Therefore, quickly, let's answer this question. The examiner is asking you whether the company should accept the special order. Now, how are we going to trade this? Are we going to determine profit or loss, or we are going to determine relevant cost of making the special order? You can see in this question there's a sales value. We are given a selling price. Therefore, it means that we must determine profit or loss arising from this special order. So what you need to do is to compare the sales value from the special order versus relevant cost of making the special order. So let me stop sharing this and quickly move to the working notes. Okay. Working notes. Okay. Let me know if you can see my screen. Can you?
Yes, sir.
Okay, thank you. So illustration next. The name of this company is Bosin. Solution to illustration 2. Bosin Limited. So we want to determine incremental analysis. We want to determine the incremental analysis of making the special order, whether it will result in additional profits or loss to the organization using incremental analysis. So if that is the case, I can say acceptance or rejection. Acceptance, number one, acceptance or rejection of a special order to produce 4,000 units. Okay. So naira. All right. So let's go back to the question. We want to deliver 4,000 units for this special at 10 naira. Therefore, we are supposed to multiply. I would then say sales equal 4,000 naira, 1,000 units multiplied by 10 naira. This gave 40,000 naira. That's the sales value. Okay. Then relevant costs. I need to compare this with the relevant costs. Okay. Relevant costs. Of making the special order. The focus should be on the special order. We are less concerned with the company's normal operation. Therefore, I will go back to the question, what are the relevant costs? To produce the 4,000 units, we are going to need direct material, and direct material is 5 naira per unit. Therefore, I will say direct material 4,000 multiplied by 5 naira, which is 50,000 naira. No, 20,000 rather. 20,000. Next item, direct labor, 3 naira. So I have direct labor. We are producing 4,000 units multiplied by 3 naira. 12,000. Next item, variable factory overhead, 75 kobo. Variable factory overhead, 4,000 multiplied by 75 kobo. So this should give us 4,000 multiplied by 0.75, 3,000 naira. Next item, we have fixed factory overhead, 1 naira 50 kobo. The fixed factory overhead is irrelevant because whether you execute the special order or not, the company will incur the fixed factory overhead. Therefore, you ignore. Next item, variable selling expenses, 25 kobo. The variable selling expenses is relevant. Okay, it's relevant, but not relevant to this question. Again, you have an option to either account for variable selling expenses. If you know that you are going to incur variable selling expenses for the special order, then you should account for it. But if you assume that variable selling expenses will not be incurred for the special order, we ignore it. As far as the scenario of the question is concerned, there is no indication that the company will incur variable selling expenses. Therefore, I ignore. Number next, fixed administration expenses, 1 naira. The fixed administration expenses of 1 naira is also irrelevant because whether you execute this special order or not, the company must incur that 1 naira for fixed admin expenses. So if that is the case, let us add up all the costs. So this should be 35,000 naira. Minus 40 will give us 5,000 naira. So that's a profit of 5,000 naira. The examiner is now asking us, rather, examiner is asking you Should the company accept a special order for 4,000 units at 10 naira per unit? So our response should be that Boasting Limited should accept the special order to produce 4,000 units to earn extra profit of 5,000 naira. Boasting Limited should accept the special order to produce 4,000 units at 10 naira in order to earn extra profit of 5,000 naira. In order to earn extra profit or additional profits of 5,000 naira. That's it. The second requirement: what is the maximum price the company should be willing to pay to an outside supplier who is interested in manufacturing these products? Examiner is asking you to provide or to determine maximum price. So number 2, something that costs you 35,000 naira. Can you pay anything more than that? So you can't pay more than what it will cost you. Therefore, the maximum price the company should be willing to pay is 35,000 naira or 8 naira 75 kobo. All right. So let's take that. Now, before we go to that number B, in that number 2, we need to state our assumptions. What are the assumptions we have made so far in our calculation? The first item is fixed factory fixed overhead. So what's our assumption on the factory fixed overhead? In the question, we are given factory fixed overhead of 150 kobo. We ignore it. Why? Therefore, let's take our assumption first before we go to number 2. Assumptions. Number 1, factory fixed overhead. I would then say the factory fixed overhead is irrelevant, or the factory fixed overhead will be incurred irrespective of the decision taken on the special order. Therefore, the factory fixed overhead is irrelevant. Variable selling expenses.
So we can hear you.
Let me reshare my screen. Okay. The variable selling expenses is relevant, but will not be included in the calculation because it is assumed that the company will not incur variable selling expenses as a result of the special order. That's that. Then what other things, what other assumption did we make? We also assume that fixed admin expenses is not relevant. So the company will incur fixed admin expenses. Number 3, fixed admin expenses this will be incurred irrespective of the decision taken on the special order. Hence, the fixed admin expenses is not relevant to the calculation. So that's our assumptions. So if there's any other assumption that you have made in the question, you have to state it. So let's move to number 2. So examiner is asking us what is the maximum price the company should be willing to pay to an outside supplier who is interested in manufacturing the products. Maximum price. Number 2. Let me change the numbers we have here to Roman figure number. Roman figure number 2. You want to say something?
Yes, sir.
Talk to me.
For these variable selling expenses, since in the question it was silent, let's say for example purpose now, we include it in our cost.
Yes.
It's a relevant cost, but because we assumed most likely they won't incur it for this special order.
Yeah.
But let's say for exam purpose now, we included it in this calculation. Are we going to be penalized for it?
No. it's that's the way you have come about your number. So you have to, the same way I'm stating this, the same way we are saying that the variable selling expenses is relevant. And if we have included the variable selling expenses in the question, what I will just say is that the variable selling expenses is relevant and therefore included in the calculation, and then included in the calculation. That's all. If you have included the variable selling expenses, you have to state your assumption. If you don't include variable selling expense, you have to state your assumption because it's a relevant cost. But when you look at the scenario of the question, there is no way that it's not clear in any way that the company will incur variable selling expenses for the special order. You are not selling the special order, isn't it? So if it's an order that you have to sell, now it's a different thing. But in this case, we are not selling it, so therefore it's not relevant. That's why we ignore it. But if you have included it as part because it's a variable cost, I mean, it's a relevant cost, and you have included in your own calculation, fine. You also have to state your assumption by saying that, oh, the variable selling expenses is relevant and therefore included in this calculation. That's all. Okay? All right. Maximum price. Examiner is asking us, what's the maximum price the company should be willing to pay to an outside supplier who is interested in manufacturing these products? Like I said the other time, you cannot pay more than what it will cost you. You've already determined how much it will cost to produce this special order. So anything above that is not acceptable. Therefore, I can say the maximum price okay. Let me go back to the question. What's the maximum price the company should be willing to pay? I would then say the maximum price the company should be willing to pay is, I don't know, as shown in the calculation below. All right, so let us go and determine the maximum price. Then once we have the maximum price, then we come and include it in the other line. Now, something that cost in our calculation, we have done the calculation and we arrive at 35,000 naira. That's the maximum price the company should be willing to pay. And that's what we are going to account for. Therefore, to change my figures, I can say maximum price. Okay. I have direct material. Direct material is 5 naira. Direct labor, 3 naira. Then we have variable production, is it production of factory? Variable factory overhead, 75 kobo. Variable factory overhead, 75 kobo. That's that. That's 8 naira, 75 kobo. So I will then go back there. This is the maximum price. So I will then go to my underline to say the maximum price the company should be willing to pay is 85 kobo. Sorry, 8 naira, 75 kobo, representing the total relevant cost of making the order. Let me write this. Representing the total relevant cost of making the order This is shown as follows. Okay, then. So that's that. Number 3. What will be the effect on the monthly contribution margin if the sales price was reduced to 14 naira, resulting in the 10% increase in sales value? Okay. So what are we supposed to do in that one? So I can say that's requirement number 3. Wow, time is fast spent. Number 3, effects on monthly contribution margin. So now, what are you supposed to do? Examiner is asking you, what will be the effects on the monthly contribution margin if the sales price was reduced to 14 naira, resulting in a 10% increase in sales volume? So to determine the effect of the change in sales volume and the selling price on the monthly contribution margin, the most important thing you will need to do is to calculate the current contribution margin, and then you compare it with the revised contribution margin for the company. So the difference will represent the effects. Okay, so this is what I'm saying. Let me just put it down for you. To determine the effects of the change on the monthly contribution margin the most important thing to do is to calculate the current contribution margin and the revised contribution margin and the revised contribution margin. The difference in contribution margin will represent the effects. The difference in the contribution margins will represent the effects. Okay? This is shown in the calculation below. So what we are saying is that for us to be able to determine the impacts of that on the contribution margin, we will need to calculate the contribution margin as at now, then another contribution margin, taking into consideration the impacts of the change in sales volume as well as the as well as selling price. So if that is the case, I will say current position, current contribution margin. Remember, this number 3 requirement has nothing to do with the special order. It's for the company. Therefore, I would then say sales. As it is, right now, the contribution, the selling price, the sales of this company currently sell 10,000 units at 15 naira. Therefore, I will say sales, 10,000 units multiplied by 15 naira. This will produce 150,000 naira. Then relevant costs. I will go back to the question. We have direct labor, okay, to be 5 naira. So direct labor, 10,000 multiplied by 5 naira. That's 50,000. Sorry, direct material. And direct labor, 10,000 multiplied by 3 naira, that's 30,000 naira. Variable factory overhead, 10,000 units multiplied by 75 kobo. That's 7,500. The company will also incur variable selling expenses. Variable selling expenses, 10,000 units. How much is variable selling expenses? 25 kobo. Okay, 0.25. That's 2,500. So the fixed factory overhead of 150 kobo is irrelevant. Fixed admin expenses is also irrelevant because we want to determine contribution. So we are less concerned. It is only when you want to determine profits that you include fixed costs. Therefore, what do you have here? That's 90,000. 90 minus 150 will give us 60,000. So this represents contribution margin. Currently, the contribution margin of this company is 60,000 naira. So let us consider the revised position. Revised contribution margin. So to get the revised contribution margin, we need to incorporate the change. So what's the revised sales volume? Examiner has told us that sales volume will increase by 10%. The current sales volume is 10,000 units. 10,000 units is the current sales volume. Plus, we're now told that it will increase by 10%, therefore multiply by 1.1, okay? Then multiply by the selling price. The new selling price is 14 naira. Therefore, what do you get? If you like, you can say 1.1. 1.1 is the same thing as 110%. Okay? If you say 110%, which is 110 divided by 100, that's 1.1. Okay? So we are saying the same thing. All right? Therefore, 11,000. That means our sales volume has increased by 1,000 units. So that's 11,000. So 11,000 multiplied by 14. 11,000 units multiplied by 14 equal 154,000. Here is 154,000. Then relevant costs. So this means that all other costs will be based on 11,000 units. So direct material, 11,000 units is the revised activity level multiplied by 5 naira. That's 55,000 naira. Direct labor, new level, new activity level at 3 naira. That should be 33,000. Then variable factory overhead, 11,000 multiplied by 75 kobo. What do you have? 11,000 multiplied by 0.75 equal 8,250. 8,250. Then we have variable selling expenses. $11,000 units multiplied by 25 kobo. So what do you have? 11,000 multiplied by 0.25 equal 2,750. 2,750. Add it up. So I have plus 8,250 plus 88,000 equal 99,000. 99,000 minus 154,000 minus 154 equal 55,000. So revised contribution margin is 55,000 naira. So examiner is now asking you what is the effects on the contribution margin. So let's advise, and that will be the end of the question. So we are going to say if selling price is reduced to 14 naira, okay, and sales volume increased by 10%, the company will lose contribution margin of 5,000 naira. If selling price is reduced to 14 naira, and sales volume increase by 10%, the contribution margin, the company will lose contribution margin of 5,000 naira. That is 60,000 naira minus 55,000 naira. Okay, that's it. That's the question. So we are done. We are done. Let me know any question on this. Do you have any question for me on this? It's a pity that I cannot introduce